Welcome back to On the Money with Secure Money Weekly Report. I'm Rob Herdig. Brian Quaranta.
Good to see you, Rob.
Good to see you, man. We're having fun. We talked about this perfect storm of things that are happening in the market that could really cause problems for those that are either on the cusp of retirement or in retirement.
Yeah. You've got a lot converging right now.
We do.
I mean, a lot converging, something we've really never seen before.
It's scary. It's terrifying. For those that aren't awake yet, you know, I almost want to reach through the screen
and tell them to wake up.
Just shake them. Wake up.
Yeah.
You remember Indiana Jones, where he drank the blood, and
Yeah.
the kid had to burn him with a stick to get him to come back to reality?
Right.
Man, we need a stick. We need a lot of them. We need to burn some people here and bring them back, wake them up.
Well, you know, people just kind of, when times get tough like this, they tend to not want to face reality, and they stick their head in the sand. You know, you'll hear people say, I don't even want to go to the mailbox and open up my statements. You cannot be that way during times like this. This is not a time to procrastinate. This is not a time to kick the can down the road.
Yeah.
This is a time to actually figure out what adjustments need to be made so that you don't have to, if you're getting ready to retire in the next couple of years, why would you want to ever put yourself in a position to where you may have to delay retirement 5 to 10 years? Because, you know, you go back to when the tech bubble bursted, you know, it took like 16 years for people to make some of that money back.
Wow.
16 years.
It's a long time.
Yeah, ask yourself, somebody watching today, do they have 16 years to wait to recover?
What's the average length of retirement? I mean, that's got to be the majority of it, right?
Well, the length of retirement now is continuing to increase. That's one of the biggest problems and challenges that we have, is that people are living longer and they're spending more time in retirement. You know, AARP said that you could spend more time in retirement than you actually did working.
Right.
Think about that.
Yeah.
You know, and that's a lot of time. You think about the monumental task there, where you've been accumulating money for 30 or 35 years, and now you need to live off of it for 30 years.
Remember the Time magazine cover that says the first person to live to 150 has been born?
Yeah, right.
I mean, if that's the case, you are going to spend a lot of time.
Yeah, and Hallmark did sell the most 100-year-old birthday cards last year.
Did they? A lot more centenarians, right?
Yes.
That's interesting. So we talked about all these things working together, and now we're going to talk about it more on a granular level. And I think we're going to talk about the legislative risk here. And you called it the greatest trick ever played here.
The greatest trick ever played, yeah. Revenue Act of 1978, right? This is when basically they said that they were going to create this thing called the 401k plan.
Right.
Okay. And the 401k plan originally was just structured for highly compensated executives to defer bonuses and stock options. That's what it was designed to do.
But the employers saw it as a chance to take the responsibility of retirement, which was expensive, right?
Yeah.
And put it on, take it from their shoulders and put it on yours. Let's talk about how retirement looked prior to that, because it was pretty good. Nobody failed. You had to be really terrible at retirement back in the 50s, 60s, 70s, even up to the 80s to fail.
That's right, because we had pensions,
right?
We had pensions, and when you retired, you had a Social Security check and you had a pension check, and that was more than enough for people to live off of. And the way that they offset the cost increasing was they would go to the bank and they would buy a CD, because back then CDs were paying between 12 and 15%.
There was no reason to take risk with your money. Why would you? And you can prove that point. Look at the volume of the stock market prior to 1978. It was non-existent.
That's right. Yeah. Well, if you look at when the 401k was put into place, I mean, the amount of money that went into the stock market and the mutual funds, it was like a hockey stick.
It just
went straight up.
What you mentioned about retirement prior to that, where you worked at the same place forever, I think people in the Pittsburgh community can really identify with that because of all the steel mills and things around here. You worked at the same place forever. When you were done, they had a big party for you. They made you a cake, and you walked out with a gold watch, and every 2 weeks you got a check.
That's right.
So why did we abandon that way of retirement? Why did we abandon something that was so good and worked so much of the time?
Yeah. Well, employers saw it as a way to actually get rid of that legacy cost. It was a lot cheaper for them to provide a 401k plan, and rather than providing a pension for the rest of their life. They basically say, hey, Rob, when you retire, you can take all this money and you can figure out how to generate that income for the rest of your life. The problem is this: most 401ks are invested in the market, okay? Which is completely fine during your accumulation years. But you cannot use, once you get to that point to where you're getting ready to retire, those same strategies and techniques that you use to accumulate your money, they're not the same strategies and techniques that you can use to actually distribute your money when you need income. And people have never been taught how to properly build a retirement plan. A lot of people are retiring with investments, and investments go up and down.
It's just like a collection. They're like an art collector. They don't even know what their stuff does.
They don't even know what stuff
When they
does.
come in, can they verbalize what it does for them?
No. No, most people cannot. Yeah, most people don't know how to take everything that they've earned and actually get it to start working for them, and to get it to start working in a way where if the markets became volatile just like they are now, they don't have to worry. You know, the way we've structured our clients, we're not worried about the market volatility because we've carved enough off to create and protect at least the first 15 to 20 years of retirement, so that any money that we do have at risk, Rob, we have the ability to actually have a longer time horizon on that money.
That's smart. So what we've talked about is a dirty trick, but it's not even the worst part of it. No. So we talked about the responsibility being shifted from the employer to the employee, right? Which is a dirty trick, right?
Yeah, it is.
That's why there's no loyalty anymore. It's why people have 20 jobs over a career.
That's
right. What's the dirtiest trick of all? Because this.
Yeah, well, the dirtiest trick at all was the fact that when you made a contribution to your 401k, so let's say you made a $20,000 contribution, you're allowed to take that off of your gross income, right? So if you made $100,000 a year and you made a contribution of $20,000, that means you only had to pay taxes on $80,000. Okay, so that was it. So it was gonna reduce your taxes, but when that $20,000 went into that 401k, it was gonna grow tax deferred. So if that $20,000 went from $20,000 to $500,000 to $1 million, that sounds great, but when you pull all of that money out, every dollar you pull out, you're going to have to pay taxes on it. And the reason it's the dirtiest trick is because they can change the rules in the middle of the game on how much you pay in taxes.
We don't even know what they are. And you look, taxes have been on sale. Look at a chart of federal tax rates over history.
That's right.
Taxes have been on sale for the last 40 years, and now we printed all this massive amount of debt.
Yeah.
Guys, draw your own conclusion with what you think is going to happen.
Yeah, you think taxes are going up or down in the future.
Right?
Right.
And we're talking about taxes here, and we're talking about there are ways you can mitigate this while you're working still, and even into retirement, right?
Yep.
And we always give people ways to do things on their own. And other than becoming a CPA or a tax attorney, what can somebody do to fix this on their own?
Well, our Right Track retirement system was all built around fixing these problems because I saw these problems from the minute I got into the business. Remember, I got in right at the end of 1999.
Yeah.
So I saw all these losses happen. I said, this is no way for people to retire. This is really gambling. And I've always thought to myself, boy, when you've won the game, when you've saved enough money, why do you continue to roll the dice and take risk with it? Because they're taking advice from people that get paid a fee or commission to take risk with their money. It's really easy to tell somebody else to take risk with their money, especially to get paid a fee or commission to do it.
This is not a time to be a do-it-yourselfer or have a financial advisor where you haven't double-checked their work in 4 or 5 years, correct?
That's right, that's right. And folks, I really want you to take advantage of this Right Track retirement review. We're going to do a full analysis on your current portfolio. We're going to go over 5 key areas. We're going to look at your income. We're going to look at your taxes. We're going to look at your investment structure. We'll talk about how to protect yourself from a healthcare event. And then most importantly, when the good Lord decides to take you home, we'll show you how to make your family and your charities the largest beneficiaries of your money and not the IRS. This is something you absolutely have to take advantage of. This is not the time to procrastinate or kick the can down the road. Take action on this and schedule the appointment. There's no cost, there's no obligation. All you have to do is pick up the phone and call 1-888-382-1298 or scan the QR code.
See, everybody can tell you how to invest your money. There's not a lot of people out there and a lot of firms that can teach you how to use your money. Most people will also tell you that they're scared. And the reason they're scared is because they're afraid of running out of money.
The last thing you want to do is have a really good job into your 60s, retire, and be looking for work again in your late 70s.
The average person might say, well, a good portfolio would be a good mix of stocks, bonds, and mutual funds. No, 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 no. A good portfolio is all designed around the 5 key areas: income, taxes, investments, healthcare, and legacy planning.
We're not just product pickers here. What we do best here is we build retirement plans.
9 out of 10 people, when they walk through the door, would ask us, we just want to know if we're on the right track. And I always say, if you're not on the right track, when would be a good time to know it? Probably now.
People, can actually see a vision once we start to really build out their plan.
This is about you. If you're not getting what you need, and you feel that when you walk out of the advisor's office, it's time to get a second opinion. And you can't get a second opinion from the person that gave you the first opinion. The difference at Secure Money Advisors, as a fiduciary firm, we help you manage the risk, build the income, and give you the retirement you dreamed of.
Welcome to On the Money with Secure Money. This is the weekly report. I'm Rob Herding. I'm here with my good friend Brian Quaranta. Brian, how we doing?
Good, Rob. How are you? A lot of things going on in the market right now, huh?
There's a ton of stuff going on.
Ton of stuff, yes.
There's a pile of stuff. So We were talking before the show about how you've been in the business here for about 22 years, right?
Yeah, long time.
And it has been a long time. You've seen a lot of different stuff. And I was thinking about 22 years ago and where that put us, right?
Yeah, yeah. Well,
where does that put us? Tell everybody when you got in the business. It was one of the most difficult times
right at the end
to
of
get into the
'99.
business.
Yeah, right at the end of '99. I mean, it was tough, man. I mean, I got into the business and I saw people losing money right away because of the dot-com bust.
Yeah.
Right? And then that carried over into 2001, 2002, 2003. My first 3.5 years in the business, I didn't see anybody make any money.
Right. Financial advisors were running from the business at that point, right?
Oh, they were hiding under their desks.
Right. Nobody wanted to pick up the phone.
Nobody wanted to pick up the phone, but they had me picking up the phone because I was the new guy at the firm.
Right.
You know, and most of the other guys, you know, the guys who've been there for 25 years were hiding under their desks.
You got to be the bad guy.
Yeah, I remember taking a call from a guy that, you know, really changed my life and why I believe in what we do today at Secure Money Advisors. But he called the office and he said, hey, my name's Sam. I need to get out of the market today. I cannot lose any more money. Well, I didn't know what to tell the guy, so I went back to the managing partner and I said, we've got a guy on the phone that wants to place a trade, wants to get out of the market, and he said, Brian, let me tell you a little bit about the stock market. He says, you need to get back on the phone and let this gentleman know that it's just a paper loss, okay, and that he's in it for the long haul. Well, like a good employee, I went back and I said that to this individual. And he said to me something that changed my life. He said, Brian, I'm 75 years old. How much long haul do you think I've got left? And that's the scary part. When people lose money, they're losing money at the wrong time and they don't have the time to recover.
It's scary. It's terrifying.
It's terrifying.
And you know, a part of the problem with this is the standard definition of terms in our field isn't there. Right. If you're an attorney, if you're a doctor, you say one term, it means the same thing nationwide.
Yep.
You go to the retail shop on the corner, you know, the one that's in every town.
Yeah.
Their definition of risk is completely different than what yours is, I would assume.
Well, we quantify risk as if it can lose money, it's risky.
Right.
Where other people might say bonds are not risky.
Right.
I think bonds are risky, okay? Because we've seen, who would have ever thought that we would be looking at the 20-year Treasury bond, right? That's down almost, what, 20%? That's, you know, if you were giving advice for somebody to buy a 20-year Treasury bond, they would assume that that would be a safe place to put their money, and they've lost double-digit returns.
Well, the 60-40 portfolio was supposed to be bulletproof, right? Because the way that equities and fixed income work,
that's right.
They have an inverse relationship traditionally.
That's right.
Well, what's happening right now?
Well, look, we've got high inflation, right? Yeah. We've got volatility in the market, big volatility again in the market. We've got every asset class being affected.
Yeah.
There's no place to hide.
You called this the financial perfect storm.
It is.
So what you dealt with in 99, 2000, 2001, 2002?
Yep.
Is that right?
Yeah, 2000.
That was tough, but it was just one risk, just the market dropping,
just
right?
the market dropping.
Now you have four things happening at the same time.
Yes, you've got high inflation, you've got volatility, you've got rising interest rates. I mean, everything's costing more. And the scary part about that for most people is most people in retirement or approaching retirement are going to be on a fixed income. So if it's costing them more to go to a grocery store, more to drive to go see their mom or their dad or their grandkids, that's a problem. A lot of these people don't have a whole lot of money left over at the end of the month anyway.
It's scary. Where do you cut from at that point? When you're on a fixed income, where do you cut? Because you have to have the necessities. You have to have the gas.
That's right.
You have to have the food. You got to eat.
Well, here's what's going to happen. It's going to force people to have to take withdrawals from their stock portfolios when the portfolios are going down. And that's a very dangerous thing to do. The biggest mistake people make when they're planning for retirement or going into retirement is they pull money out of accounts that are in the stock market. And so now you've got the market going down, they're losing money because the market's going down, and on top of it, they've got rising costs. So to offset that cost, they're going to take more money out of their portfolios.
Right.
This is something we call in our business called sequencing risk.
Right.
This can cause people to run out of money, and people will run out of money. I meet these people, Rob.
They were told for years that the systematic withdrawal approach, the 4% rule,
that's right,
would last them forever.
Right.
That 4% rule has gone down every year. It's, what is it now, 3.5%, 2%?
Yeah, well, the Wall Street Journal said that if you retire at the top of a bull market, right, that there's a high probability you could run out of money. Matter of fact, the article said that there's up to a 57% chance that your plan could fail if you retired at the top of a bull market. Why? Because most likely it's going to go down, and that's exactly what we're seeing happening right now.
Well, you get this false sense of confidence when you get returns and you win and you win and you win, and you start to think like, hey, I'm never going to lose.
Right.
And then we have all these people doing it themselves, and they're not professional planners, they're not financial advisors,
right?
And most of them leave their wives in the dark. You experience it a lot, right? When the husband comes in and he's got the plan, and you know, he's going to take care of everything because he's the man, right?
Right. Well, a lot of people were very overconfident. You meet a lot of people that, you know, were investing in a lot of cryptocurrency, a lot of individual stocks. They were making a lot of money in tech. I remember meeting a guy a couple years ago that had quite a couple $1 million saved. And he was making a lot of money in the stock positions that he was in. And I told him, I said, look, I think with you being about 3 years out for retirement, the best thing we could do is protect some of this money and set up a pension for you for the rest of your life that would increase over time. So as cost of living went up, we would have enough cash flow coming in. He said, Brian, why would I want to take my money out of the market right now? I'm making so much money. I said, that's the exact reason why you want to take the money out of the market, because you are making money. If you made money for the last 12 years, and he said, I just can't see doing it. Now, he just called me again, and his portfolio has been cut almost by 40%. By 40%.
It's not a win until you take it off the top, right?
I've always said, Rob, if you've won the game, why keep playing it?
Because you're getting bad advice is why you keep playing it. So you've been a financial advisor for 22 years.
Yeah.
What most people don't know is my background. I'm a consultant, and I work with financial advisors all over the country.
Yep.
And I get it. I've got a pretty good view of what's going on in the world. And it's funny. There's so many people out there, and I can say this, you can't, because you're the bad guy if you say it.
Right.
But there's so many people that are willing to put their own financial success behind their relationship with their financial advisor. Meaning, they're more worried about upsetting their financial advisor and doing what's right for them.
Yeah.
Than they are upset. It's insane.
Breaking relationships. It's very hard for people to break relationships.
In a time like this,
Yeah.
it's dire. You have to get a second opinion.
Yeah.
We haven't even talked about the legislative risk with the increasing amount of cash we've printed, right?
Well, Rob, I'll tell you, that is a big risk, but I'll tell you why a second opinion is so important. Because typically the advice that people are going to get, okay, the traditional advice to get, and I know this because when I started in the business over 20 years ago, these are the cookie cutter things that I was taught to say at the financial firms. Don't worry about it, hang in there, it's just a paper loss, it'll come back.
Right.
These are just sound bites to manage emotions. These are not
Everybody's
real strategies. They're not real strategies.
Right. That's not a plan.
That's
Hold on is not a plan.
Hold on is not a plan. And this is why I really would like to see people take advantage of our Right Track Retirement Review, because we really lay a lot of this stuff out for people where we can show them how to maximize their income. We can show them how to reduce taxes. We can show them the proper investment mix to have so that if the markets do continue to be volatile, that they don't have to be walking around on eggshells wondering whether or not their plan's going to work.
What's happening right now is scary. Each one of those challenges by themselves can derail a retirement plan. We have all four working in unison together right now against us. They're not working for us, they're working against us. We always give people ways to fix stuff on their own. This is not something a person can fix on their own. This is not something a do-it-yourselfer can do on their own. Hey, I think we're out of time here. I think we're going to commercial break, and I think you have something for the audience.
Let me just tell you, take advantage of the Right Track Retirement Review. It's really going to help you with 5 key areas: income, taxes, investments, healthcare, and legacy planning. We'll show you how to maximize your retirement. We'll show you how to get through these volatile market times. We'll show you some better approaches that you might not even be aware of. All you got to do is call 888-382-1298 or scan the QR code at the bottom, and you can schedule an appointment with us.
See, everybody can tell you how to invest your money. There's not a lot of people out there and a lot of firms that can teach you how to use your money. Most people will also tell you that they're scared. And the reason they're scared is because they're afraid of running out of money.
The last thing you want to do is have a really good job into your 60s, retire, and be looking for work again in your late 70s.
The average person might say, well, a good portfolio would be a good mix of stocks, bonds, and mutual funds. No. A good portfolio is all designed around the 5 key areas: income, taxes, investments, healthcare, and legacy planning.
We're not just product pickers here. What we do best here is we build retirement plans.
9 out of 10 people, when they walk through the door, would ask us, we just want to know if we're on the right track. And I always say, if you're not on the right track, when would be a good time to know it? Probably now.
People, can actually see a vision once we start to really build out their plan.
This is about you. If you're not getting what you need, and you feel that when you walk out of the advisor's office, it's time to get a second opinion. And you can't get a second opinion from the person that gave you the first opinion. The difference at Secure Money Advisors, as a fiduciary firm, we help you manage the risk, build the income, and give you the retirement you dreamed of.
Welcome back to On the Money with Secure Money Weekly Report. I'm Rob Hertig, here with my good friend Brian Quaranta.
Rob, how are you today?
Man, I'm awesome.
Good.
I'm awesome. I know you are too.
Yeah,
I know
very
you are
busy
too.
though. Very busy though.
Yeah, people are worried right now.
Yeah, they're very worried, and they have every right to be. They have every right to be, because you're talking about 40 plus years worth of work at risk in the market right now. I've met a lot of people that are just losing a lot of money right now. They're terrified. You talk to other people and they don't even want to face the reality of what might be happening to their 401ks or their retirement accounts. But it's not a time to stick your head in the sand. This is not a time to kick the can down the road.
When you have 14 years of positive reinforcement, right?
Yep.
We're winning, we're winning, we're winning. And even in 2020, we had some of the most volatile days the market's ever seen. 2,000 point swings one way or the other. And we still finished 2020 up. Right? All through COVID.
All through COVID, yeah. And it was the, it was the injection of all the capital into the market too. I mean, come on, we had kids that were investing their money that they were getting for college through their Robinhood apps or their TD Ameritrade apps, and they were making a ton of money, right?
Crazy.
I mean, how many people have we heard, millionaires, how many stories I hear from our clients about their grandson or their granddaughter making $1 million in cryptocurrency?
Right.
It was just, when I saw that happening, I knew we were at the peak. Because when you hear things being that easy, you know the run's about to be over.
Like Henry Ford, when he said he knew how to get out of the market because a shoe shiner gave him investment advice.
Yeah,
right.
That's
like the market's saturated when the guy's shining your shoes.
It's giving you investment advice.
You're
That's
in
right.
a bad spot.
Yeah.
It's tough. Both money managers and consumers get this confidence as years go by and they're winning, and it's almost like they forgot that you can lose at some point.
That's right.
We get guys that are on the TV with commercials saying, certain things that we used in the past to make sure we live great retirements, that they're bad and we hate them and we don't have them. I'll bet you the people that are with that guy right now wish they had an annuity. Yeah,
well, annuities are a very important part of planning. I mean, for some cases, not all cases. Everybody's situation is different, but you got to remember that the losses will hurt you more than the gains will help you. Right. Let me say that again. The losses will hurt you more than the gains will help you. So, and the reason I say that is because when you retire, it's not about getting 100% growth of the market. It's about protecting your downside. And most people don't hedge by protecting their downside. So, market goes down, they lose 20%, 30%, 40%. We need accounts that if the market goes up, we can make a little bit of money, but if the market goes down, we don't lose. And the design of these annuity products today will allow us to do that, but they'll also do something else very important. They'll provide us with a guaranteed income stream. Not only guaranteed for your life, but guaranteed for your spouse's life. And any money in the account will go to your family members, or at any point in time you wanted to take that money out, you could take it out. Depending on when you take it out, you could pay some penalties. But at the end of the day, we have ways to protect money today and still get some growth in the market.
You're a fiduciary, the other advisors at your firm are as well. And by law, you have to do what's in the best interest of the client, right?
That's right.
My problem with what happens, in the media, there's always certain themes that start to get carried away, and there's always multiple versions of the story, right? We see it over and over again. So this narrative that annuities are bad, well, there's 4 or 5 different kinds of annuities, right?
That's right.
And what I've noticed is these people on TV that run these commercials, they are taking the worst parts of every different type of annuity and combining them like they're one organism, and they're not.
That's right. They lump it all in together.
Right.
It's not a fair analysis, right?
And I think there's bad annuities.
Oh, absolutely.
And I think there's good ones. I think there's ones that are appropriate for people and ones that aren't.
Yes, and you got to know, in the annuity market, you have to know what you're looking at in order to purchase the right one and get the right one that's going to solve the problems that you need it to solve.
Right. Some do accumulation, some do income for life that you can't outlive, that's guaranteed. Even if you outlive the money that's there, you have a payment coming in. So give me an example of where you would use like an accumulation vehicle.
Yeah, well, look, so let's say you're getting ready to retire, right? And you're retiring, and the only amount of income that you're going to have on a guaranteed basis is your Social Security check, okay? So let's suppose, and this is about 85% of the people retiring today, right? Let's say that you need an extra $20,000 a year in income, right? Well, you've got 2 choices. You could keep all your money at risk in the market, and you could pull that $20,000 a year out of your investment portfolio, okay? And as long as the market cooperates, you got nothing to worry about.
Taxes don't go up, no inflation, no market drops.
No market drops, most importantly, right? No market drops, most importantly. But if you're trying to get $20,000 of income out from a stock portfolio, and you pull that out and the market's going down like it has been, now you're compounding those losses, and this is what we see where people will spiral and run out of money. And they're not running out of money in the first 10 years of retirement. They'll run out of money in like 15 to 20 years when they don't have the physical health to go back to work.
You need it the most.
When you need it the
When
most.
you're the
you
most
got it.
vulnerable.
When you're the most vulnerable. So what the annuity does is by carving that money off, by carving a portion of your money off and placing it into that guaranteed account, we can provide that income stream of $20,000 a year.
Yeah.
And in even some annuities, that $20,000 a year would increase every year.
Yeah.
Okay, so we can even get increasing income. Now you tell me, would you rather have an account that could run out of money, or would you rather have an account that wouldn't run out of money?
Well, people over the last 14 years, they fell so in love with that account balance.
Yes.
And they thought that was important. And I think what they're finding out is a paycheck is way more important than that great big account balance. We've convinced everybody to operate like we're all independently wealthy, right?
Yes.
Let's do it like the wealthy do. Well, you don't
Yeah.
have the money to do it like the wealthy do.
That's right.
Wake up.
That's right. I always say, would you rather have $1 million in your account, or would you rather have a guarantee of income of $50,000 coming in a year? I would rather have a guarantee of income of $50,000 coming in a year rather than $1 million sitting in my account that could go down and I could lose it.
Yeah.
You're right, Rob. That income is more important than the account balance itself. It's the monthly income that gives you peace of mind and security in retirement and really allows you to have the retirement that you always wanted, because nobody wants to be worrying about the pandemonium on Wall Street when they're
Right.
retired. They want to be spending time with their kids and their grandkids, right? And their families and going on vacation. They don't want to worry about being on vacation on some cruise and the market just dropped 30% and they're thinking to themselves, we probably shouldn't spend the money we're about to spend on this cruise because we're not going to have a whole lot left after the market takes it from
Yeah,
us.
you actually just made me think of something. So the prospects, the people you're meeting with that are coming in that are scared,
Yeah,
a lot of them have lost 20, 30, 40% in the market.
correct.
How much have your clients lost in index annuities?
Yeah, zero.
Zero.
Zero. You cannot lose money in those accounts. And even, you know, the other good annuity is even something called a fixed annuity where you can get a guaranteed rate of return.
Kind of like an old CD, right?
Like an old CD
Yeah.
where you can get, 3.5%, 4% rate of return. We'll probably see those rates go up even more.
Oh, I'm watching it day by day. As the interest rates are going up, I'm seeing those yields on the back sides of those climb as well.
That's right, Rob. These indexed annuities are alternative asset classes that are not correlated to the stock market. That's the most important thing. They're built off an options portfolio that allows you to get this upside gains without the losses. But this is why our Right Track retirement system is so important, because I've built this out to cover all of these areas. And I want people to have this information. And folks, if you call in and schedule a time to come in, I'm gonna walk you through our Right Track retirement system. We really have done a good job breaking this down so you have a simple, easy to understand plan that's gonna provide you with income and peace of mind in retirement. We're gonna show you a better approach than just rolling the dice and taking risk. If you've won the game, folks, there's no reason to keep playing it. Take advantage of the Right Track retirement analysis. All you got to do is call 1-888-382-1298. Again, that's 1-888-382-1298, or scan the QR code.